bold call, S&P 500 at 7,000 by next year. I want to ask you, what's the catalyst? Is it almost entirely AI enthusiasm, or are there other factors like Fed rate cuts, nearshoring, et cetera?
Well, there's a bit of Fed rate cuts in there. That will help. We think there's probably room for 2 cuts this year, with more to come next year. Our forecasts are a bit below what the market's pricing in terms of the future path of interest rates. So that helps. That certainly helps the equity market story. And there's some earnings growth as well. We've argued for a while that we think the US is on a path to a soft landing. That helps corporate America. So there's some earnings growth. But it's, as you suggest, principally about this inflation of a bubble around AI. And I think it is a bubble. We've done a lot of work looking at the economic and the market consequences of groundbreaking technologies such as AI. And one of the lessons from history is that it takes a long time for these technologies to generate productivity gains. We think in the case of AI, they'll come, but they'll come towards the end of this decade. But markets tend to try and capture those perceived future benefits ahead of them actually crystallizing in the real economy.
Let me go back to one thing you said. I want to go back to what you said. So you said you think it's a bubble, but clearly you don't think this bubble is anywhere near popping because you think we're going to hit 7,000 next year.
That's exactly it. So if we're right and it's a bubble, then it has further to inflate. Now, there's different ways you can measure this, and no two bubbles are the same, clearly. But the dot-com bubble at the turn of the 2000s perhaps is instructive in this regard. And if you look at things like forward 12 months earnings, P ratios, that suggests that this bubble's nowhere near yet at peak valuations.
So, Neil, you're hitting on something over and over again. Earnings. You keep mentioning earnings, okay? So I do want to talk to you about earnings. Strategist out with a note, talking about sales for techs, expecting to have the strongest growth rate at 9.5%, outperforming the S&P's overall growth rate of 4%. They go on to say they're warning that the biggest risk to earnings, first we're talking about sales, now we're talking about earnings, is a shift from AI euphoria to AI disappointment. I'm just looking at the earnings estimates. Q2, 11% earning estimate, and then for Q4 and Q1 of next year, 15% earnings estimates. Each one of these inflection points of earnings, how important are they in your mind to get to this path of 7,000? If we see a stumble in any one of these earnings periods, does that break down your case, or can it still power past that?
No, I think if we get a stumble in the earnings picture, then I think it does break down the case. But so far, we've not really had that, right? If you look at the path of earnings, they've continued to grind higher and continue to blow past expectations in most cases. So now the point is that you still get to valuations that look very frothy despite that solid earnings growth. So I think we continue to get solid earnings growth. It's just that investor enthusiasm it perhaps outpaces that earnings growth.
Okay. Also, why 7,000? I mean, what's about that number? That kind of implies a 25% increase from where we stand right now. Again, hitting our 37 record high. What is about 7,000 in your mind? This the number? Like, why isn't it 8,000? Why isn't it 6,500?
Exactly. That's a good question. The simple answer to that is that if you look at the level that valuations tend to get to in bubble territory, in bubble conditions around new technologies, that gives you an anchor for your forecast. So we can look at the valuations that we've seen in the past, and we can try and project those forward. When you do so, you get to a kind of 7,000 number, maybe even a touch higher. But like I say, this is a bubble. I think we should be there should be no doubt about that.